Bitcoin has been trading sideways, mostly between 84k and 86k. This reinforced this level as a significant short-term support. For now, the market is in a wait-and-see mode, with both bulls and bears defending their zones. To the current death cross from April 7th, if history repeats itself, this could also be signaling a bottom. Things may stay choppy for a bit, but we could be setting up for a move back to the upside. So, if history is any guide, we might be at or near a turning point. And the US-China trade war? That's the elephant in the room, and a very big one. Whether we hit new highs or see more downside depends on what happens next week. Zooming in on Ethereum, ETH dominance has taken a hit, as you can see. We could be approaching a reversal zone here too. After April 13th, however, the largest whales, 1 million to 10 million in brown, showed a sharp move upward, signaling strong net buying. Between April 7th and 13th, the same window shown in the data, strategy bought 3,559 Bitcoin for $285.8 million at an average price of around $82,618 per coin. Near a turning point? Hi everyone, Neil here and welcome to the channel. Nothing new for today's video. The stock market is still feeling the impact of last week, one of the worst in 5 years. Trade tensions are continuing to rise. Despite the chaos, all three major stock indexes on the New York Stock Exchange closed slightly higher, with less than 1% gains across the board. Less than 1% for the three. Although the uptick wasn't huge, the fact that they still rose suggests that the market believes Trump might be softening its extreme tariff stance. And here we are again. Trump implied some tariff relief for car companies, which gave the auto sector a bit of a breathing room. However, with this pattern of bold claims and quick reversals, let's not fool ourselves. We are definitely in a period of uncertainty, something markets hate. But the question everyone is asking is, did we just hit the bottom or is there more downside ahead? Let's break it down. Let's take a look at the heat map to see where the Bitcoin price is going. Bitcoin has been trading sideways, mostly between 84k and 86k. The price has tested both the upper and lower bounds of this range several times, indicating indecision and consolidation. You can see this in the chart, where the price moves back and forth within that band, never really breaking out in either direction. Importantly, there was a brief dip to around 83.5k, marking the local low for this period. After touching 83,500k, buyers stepped in and the price quickly rebounded. This reinforced this level as a significant short-term support. We can see bright horizontal bands on the heat map, particularly just above 86k and slightly below 84k. These bands represent a dense cluster of liquidation levels, where many leveraged positions are stacked. For the resistance zone, the bright band above 86k suggests a high concentration of leveraged short positions. If the price breaks above this level, we could see a wave of short liquidations, triggering a potential short squeeze. That makes this zone a strong selling of resistance. For the support zone, on the flip side, the cluster around 84k and just below shows where long positions are at risk of being liquidated if the price dips. This creates a strong support zone, as buyers typically step in to defend those levels. What to watch for? A decision move about 86k could trigger a cascade of short liquidations and send the price higher quickly. Conversely, a drop below 84k could trigger long liquidations and accelerate a move downward. For now, the market is in a wait-and-see mode, with both bulls and bears defending their zones. Until a clear breakout occurs, expect continued choppy, range-bound trading. Now, let's zoom out and look at the bigger picture, both technically and from a macro perspective. Jumping into the daily Bitcoin chart, we are pulling up the 200 DMA, the red line, and the 50 DMA, in green. On April 7th, we saw the 50 DMA cross below the 200 DMA, which marks a death cross. And this signals a big drop that we have recently gone through on the first week of April during the announcement of Tariff Day. Maybe you already know the difference between the two, but just to recap. 50 DMA, it's the average price of over the past 50 days, reflecting short-term trend. 200 DMA, the average over the past 200 days showing the long-term trend. So, what does death cross mean? It suggests that short-term momentum is weakening and that the asset might be entering a longer-term downtrend. It's a bearish signal that can often trigger additional selling due to shifting market sentiment. But it's not always as bad as it sounds. The last time we had a death cross was on August 12, 2024. And, interestingly, it signaled a local bottom. The price action was choppy afterward, but the trend had reversed to the upside later. So, coming back to the current death cross from April 7th, if history repeats itself, this could also be signaling a bottom. Things may stay choppy for a bit, but we could be setting up for a move back to the upside. So, if history is any guide, we might be at or near a turning point. But let's be real, it's not just about charts. The macro backdrop is driving everything right now. And the US-China trade war? That's the elephant in the room, and a very big one. China is the second largest economy and the US imports a huge amount from them. So, when tensions rise, global markets feel it. It began with Trump's 34% reciprocal tariffs. China matched them, markets dropped. Then, Trump threatened 50% more. China responded, raising tariffs to 84% and banning rare earth exports, a major move given their importance to tech and defense. The US hit back with 125% tariffs, now raised to 145%. China matched again. Markets tanked, worst week in 5 years. Whether we hit new highs or see more downside depends on what happens next week. Adding fuel to the fire, US 10-year bond yields have been spiking, now at 4.5%. Why does it matter? Rising yields mean higher borrowing costs for the governments, companies and households. It can drag on growth, dent corporate profits, and cool off the economy, none of which markets like. Some analysts even think this bond market stress is what pushed the administration to hit pause on further tariff hikes. So, is the Fed ready to pivot now? That's the million-dollar question. There is growing speculation that we are nearing the end of the tightening cycle. The CPI recently came in lower than expected, dropping from 2.8% to 2.4%. There is a significant shift and could bring us closer to the Fed's 2% inflation targets. If inflation keeps falling, the Fed may finally have the green light to pivot and start easing, and that will be bullish for risk assets across the board. And let us not forget global M2 projections, the broad money supply, are starting to trend up again. That's another potential tailwind for markets. Now, zooming in on Ethereum, ETH dominance has taken a hit, as you can see. But, interestingly, the last time we were at these levels was right when quantitative tightening ended up in a past cycle. So, we could be approaching a reversal zone here too. If the Fed pivots and liquidity returns, altcoins might be set for a strong comeback. Let's go to the order book and whale activity. Take a look at the top panel. There is a clear buy wall, support around 81k, and a strong sell wall, resistance near 88.5k, highlighted in orange, which are likely to influence short-term price movements. The price, blue line, has been moving between these two levels, showing the market is range-bound, and there has been signs of change in whale activity. From April 7 to April 13th, the CVD lines for all major order sizes, including the largest whales, like 1 million, 10 million in brown, the mid-sized whales, 100k to 1 million, purple, and 10,000k, 100k in red, trended downward, indicated sustained net selling during this period. After April 13th, however, the largest whales, 1 million to 10 million in brown, showed a sharp move upward, signaling strong net buying. The mid-sized whales, purple and red lines, also showed a slight recovery, but their buying was much less pronounced and quickly leveled off or turned back down. If buying from large whales continues and lesser whales shift more to buying, Bitcoin could challenge the 88.5k resistance. If not, the price may remain range-bound between 81k and 88.5k. Interestingly, we might already know who that large whale is. Between April 7th and 13th, the same window shown in the data, Strategy bought 3,559 Bitcoin for $285.8 million at an average price of around $82,618 per coin. That's not a coincidence. The size and timing of Strategy's purchase lines up almost perfectly with the on-chain buying behavior we are seeing on the charts, especially the sharp uptick on April 11th, 12th. They funded the buy by selling nearly 960,000 shares of MSTR stock, continuing their aggressive Bitcoin strategy despite intense market uncertainty. And keep in mind, they are sitting on $8 billion in debts and expect an unrealized Q1 loss of $6 billion USD. Still, they went all in. That's conviction. So, why does this matter? Because it signals strong conviction. Despite the macro uncertainty, technical bearish signals, and ongoing market volatility, Strategy is not waiting for perfect conditions. They are accumulating during consolidation. This type of institutional buying suggests that large players see the current price range around 81k, 83k as a strong value. It adds credibility to the support zone and could encourage further buying interest from other market participants. In other words, this isn't just another data point, it's a potential signal that smart money believes we are near a bottom, which could set the stage for a broader move higher. So, here's my take on Bitcoin's current valuation. Right now we're sitting in the low 80k range. Given the level of institutional accumulation, the macro setup, and how much fear is already priced in, I'd argue that Bitcoin is undervalued relative to its long-term trajectory. We've seen strong hands, like Strategy, stepping in aggressively. We are also seeing signs that liquidity may be returning globally, and historically, these are the moments where Bitcoin lays the foundation for its next big move. That doesn't mean we won't see any more short-term volatility. If 81k breaks, we could revisit the 78k or even 74k area. But from a long-term perspective, I believe the current price range offers real value, especially for those with a multi-month or multi-year time horizon. So, while this may not be the explosive breakout moment just yet, I would say Bitcoin is in accumulation territory, not distribution. So, that's all for today's video. We are at crossroads. If the US and China reach a deal and inflation data keeps cooling, we could be on the verge of a new rally. But if trade tensions worsens or inflation surprises to the upside, we might still have some downside left to navigate. Either way, we are in a pivotal moment. Keep your eyes on bond yields, CPI data, and trade talks. And remember, volatility creates opportunity, especially for those who stay informed and think long term. So, what do you think? Have we seen the bottom, or is there another leg down coming? Drop your thought below. Thanks for watching, and as always, stay sharp, stay informed, and I will catch you in the next one.